Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. And if you've been a subscriber of Palisade Research, which can be found at palisade-research.com, we've talked quite a bit about our guest today who's on the program, Anthony Milewski. Anthony is the CEO and chairman of Cobalt 27, which can be found on the venture under KBLT. Just IPO'd, and I believe it was the largest IPO since Ivanhoe back 3 or 4 years ago. Anthony, welcome to the program.
Colin, thanks a lot for having me today.
Yeah, you're an expert on Cobalt, and I was trying to get you on a couple months ago, but you've just been so busy, and you finally had a few minutes to sit down. You're coming to us from Zurich today. You're an expert on Cobalt and the battery metals. And so I want to start out, my number one question here is, the case for battery metals is clear to make. A lot of people in the United States are focused on Tesla, but that's only one small application of just how much the world is moving towards electric power, electric vehicles. Many components go into batteries. You have graphite, lithium, nickel, vanadium, just to list a few, but Cobalt seems to be your favorite, and I want to start out understanding why you like Cobalt so much.
Sure. So, I think that, as you said, there are a lot of different and interesting ways to play the electric vehicle adoption story, and all of them have their merits. The reason I have focused in on Cobalt at this time, and I say that because over time, the cycle will be such that there will be different opportunities, but I've really focused in on Cobalt because Cobalt is a byproduct of nickel and copper mining. And if you look around the world, what you find is, with the exception of Managem in Morocco, there are almost no primary cobalt deposits in the world. That's interesting because you have an explosion in electric vehicle demand in the past 2 years. You have analysts predicting, growth and a penetration rate of between 14 and 30% in 2025. And so you have this enormous demand that's come into the market for a metal that no one's really cared about in 20 years or maybe ever. And you don't have the ability for the supply side to respond very quickly. Now, ultimately, the supply side will always respond, but not like some other metals where in a matter of weeks or months or a year, say, you can have a material response. With Cobalt, the response is much longer and much slower than many of the other metals. And that really captivated my attention because, I think that the rollout and adoption of the electric vehicle is going to be far swifter than anyone anticipates, and the response to that on behalf of Cobalt is going to take longer and be more difficult than people think. So I think it's just sort of the perfect dynamic in a metal.
Let's talk a little bit about the price sensitivity on the demand side. We're very big proponents of uranium. We've talked about it a lot. One of the reasons I like uranium so much is that if the price goes from $20 a pound up to $100, it has very little impact on the end user, being the utility. They're willing to pay whatever price they need to. And I think the same can be said for Cobalt. If Cobalt prices, which have already doubled in the last year, double again, will that impact the world moving towards electric vehicles and implementing Cobalt into battery production?
Look, it's my personal belief that that of course, if Cobalt doubles from here, there will definitely be an impact, although it won't be significant. And I'll give you the basic example. The MSRP of the new Tesla, less than approximately, less than 0.08% is actually directly related to the price of Cobalt. And the other thing to kind of understand about Cobalt here is $1 in the Cobalt price doesn't translate into another $1 in the price of a car. And the reason is you have cost compression across the value chain. So, there are different people making the batteries as you move along that value chain. And so there's kind of two things. One is just the simple fact that in terms of the overall impact on the MSRP, it's not material. I think that's one part of it. I think the second part of it is simply that, people kind of misunderstand, thinking that $1 increase in the Cobalt price translates into a $1 increase in the price of the car, and this isn't accurate. Ultimately, when I think about a $30,000 electric vehicle, and I think about Cobalt being higher and maybe, costing an extra $300. I don't know when the last time you bought a car was, but at my household, the determination was, where the coffee cup holder is going to go, not whether or not there's an extra $300 in cost. So I think in the short term, a higher cobalt price doesn't impact the demand. I think that in fact, I think that cobalt is just like every other commodity, and that means there's a caustic incentive price. And what we really need to do is find that incentive price to incentivize new production to come online. And I don't think that as we find that incentive price, it's actually going to cannibalize demand, because having a higher price when it's such a small percentage of the overall cost is not going to fundamentally change the demand profile of the people who are entering the market currently.
Lithium has been on the minds of a lot of investors for the past couple of years. It's bucked the downward trend of the commodities, even back before 2016 when the commodities were in a downturn. And you've made the case to me before that there's significant supply response for lithium. So first of all, I want to ask you what that means. But also in terms of cobalt seems to form in high grade but smaller deposits if it's a primary cobalt deposit, whereas lithium is in large brines. Entire valleys are covered in lithium, and it seems like a completely different dynamics in play for the two metals in terms of production.
Yeah, look, lithium is a primary metal. So you have, as you noted, whether it's the spodumene deposits or whether it's the brine, that you actually have primary deposits. So I think calling the top for lithium is incredibly hard to do. When you have a structural change in an industry like we're seeing with electric vehicles and battery storage, these things tend to run longer and harder than people think. And I mean years. I'm thinking in terms of years now. So for me to call the top of lithium is not possible. I'm a huge proponent in the electric vehicle penetration rate, and I think that, in fact, that rate, as I indicated earlier, is going to be more intense and happen faster than people think. So, I think lithium is still interesting and remains interesting. It's just that over the course of time, and whether that's 5 years or 2 years or 7 years, I don't know, you're definitely going to see a supply side response. You can see that in the form of mines being built currently. You can see that in SQM and Albemarle increasing production. It's really a timing issue. So I don't have a response there. As to cobalt is definitely a different animal. With the overwhelming majority of cobalt coming from copper and nickel, I like the anecdote from the CFO of Sherritt, and he was talking at a Canaccord conference a couple weeks ago, and he said, look, our ratio of nickel to cobalt is between 9 and 11 to 1. And even at I think he said $150 cobalt, you still wouldn't build the mine for the cobalt, you'd be building it for the nickel. And so when we're talking about where the additional or incremental supply comes from, I think it's a nuanced conversation. And I think there's really three kind of sources. I think the first source is going to come from the price of cobalt going higher, and I think it's probably material higher, because you have to find that incentive price. And if history is a guide, if you look at iron ore starting at $10 going to 225 and then back down to 60 or 70, you see that these markets will overshoot. So I think one, you're going to see cobalt go higher, find an incentive price, and then you'll see some of these mines. There's several in North America. There's a few projects in Australia that are going to get built. I think that's probably a 3 to 5 year program in terms of raising the capital and building those mines. I think another source is units from things like some of the HPAL production, where they can recover more cobalt. Once again, that's capital intensive and probably takes a couple years to kind of get dialed in. And then I think the third source, of course, is the battery itself. When people talk about substitution in the lithium-ion battery, or in particular, in the batteries as it pertains to automobiles, I think that they sometimes misspeak and they talk about substitution. I think that's wrong. I think what you're really talking about is innovation within the lithium-ion battery. The lithium-ion battery has been around for over 20 years, and if I think about what's going to happen as cobalt increases in price, the main kind of innovation that you can foresee happening is a move around the chemistry. So you have the nickel manganese cobalt chemistry, which is a 523 chemistry currently, going to a 622, meaning 6 units of nickel, 2 units of cobalt, 2 units of manganese. The next generation of battery is an 811. Now that generation of battery is probably 4 years away. if you talk to Panasonic and if you talk to LG. But what I would say is, if Cobalt was sitting at 60 or $70, what you would find is human innovation is such that they would be able to bring that in, they'd be able to bring that chemistry forward a couple years. So from my perspective, the three sources of additional material over time are 3 to 5 year range, new primary production. I think, in maybe the 2 to 3 year range, collecting additional units off of some refineries and HPAL facilities. And then kind of, potentially, and I say potentially because currently the 811 doesn't work, in any scale, but potentially you could take that chemistry and bring it forward a couple years.
You alluded to the drastic commodity price of iron ore in your last response there. Cobalt is a commodity that has pretty violent moves. I know just a few years ago it shot up about 4 or 5x, and we're really just in potentially the beginning part of the move here. Have you looked at the historical response that you get when cobalt starts to move, and has that given you an indication of where you think cobalt could end up on this run?
Yeah, no, I mean, just to give people some perspective, if you look at the CRU report that was published within the last kind of few months, what they'll tell you is in the mid 20s on an inflation adjusted basis, you're just getting back to the 30-year average now. So granted, we've moved a few dollars past that. But, actually the last few years have been in the anomaly, not the norm on an inflation adjusted basis. Also, I would note, you were at one of the 2 low points in 30 years. So you're starting from a very low base. But in particular, if you're talking about 2008, when cobalt ran over $50, you're talking about a couple of things there. One of them, of course, is really the advent, or I should say the adoption of the smartphone with its battery. And then you're talking about a war in the Congo. And the response was twofold. One of the responses was just the tail of the commodity super cycle, in that some of the big projects like Embatavi, which were years in the making, came into production. So that was just a function of the super cycle and cobalt being a byproduct. And then the second, more nuanced aspect of it was really the artisanal miners in the Congo. And they produced a huge amount of material in response to that price move. Now, it's worth asking, why is it different this time? And by the way, there's artisanal miners and there's artisanal mining, right? There's kind of structured artisanal mining that is supported by certain groups, and then there's child labor, and they're different. I would note that first of all. So to address artisanal mining, I think there's two things. The first is the illegal child labor stuff. It's the focus of a lot of these companies that are end users of the cobalt. I think no one wants to know of or see this type of material in ultimately their cars. I mean, the automakers by and large aren't buying it. It's the battery makers. So you see a concerted effort to make sure that you can verify through the supply chain the cobalt. So that's part of it. And then there's a second part of it, which is just a little bit more practical, which is that a lot of the easy artisanal stuff was mined out in that kind of post '08 period.
Anthony, let's shift gears a little bit now into how to get exposure to cobalt. When you're looking at precious metals like gold, there's obviously gold exploration companies, there's production companies, and then there's things like the gold ETF or physical gold that you can purchase. So investors have quite a few options. Cobalt, as of maybe 16 months ago, would have had 3 or 4 publicly listed vehicles, and they all would have been likely exploration companies. That, of course, is expanded now, as the venture exchange always does when interest comes into a commodity. But there's not very many ways to invest in cobalt. The company you just listed, Cobalt 27, is certainly a unique way to invest. It essentially creates direct exposure to cobalt, and I want you to talk to our audience about how you've set that up and how that works.
Yeah, so as you noted, and a lot of it kind of depends on your risk profile. With Cobalt 27, we were really trying to put together an investment grade product for institutions and retail investors who aren't looking to kind of be up 50 times or zero. Like some of these junior companies, and by the way, that's a perfectly valid way to invest, are very binary. Not all of them, of course. There are definitely some great serious stories, but we tried to kind of structure a little bit of a different risk profile. And what I mean by that is, we have 2,158 metric tons of cobalt. So our NAV is underpinned by physical cobalt, which you can mark on a mark-to-market basis add the cash in, and you can come up with our market cap essentially. So, from my perspective, it's a very benign way to play what is a very important story right now, meaning the electric vehicle adoption story and the battery energy storage story. So, what I think is probably interesting is what we're planning to do with it going forward. And there's a couple of things. I mean, one thing we can do is, as this trades at a premium to NAV over time, we can raise capital and buy additional physical. I think that's one way. And you saw Uranium Participation Corp do this, and they did it fantastically during the bull market. I think another thing we can do, and that we are intending to do, is go out and acquire producing streams. So, we think that the growth and scale of the company will come through the acquisition of streams over time. You can see when we launched, we have 6 royalties over 8 properties. Those are sort of out of the money options, but it's really putting together a pure play of scale for investors. And we like to think about it in terms of asymmetry of risk. So, what is the risk profile here? On the one hand, you probably don't have, frankly, the upside of one of these junior miners who, if they drill a hole, they're going to be up, multiple 100%. Like that's not really what we're doing here. Instead, what I foresee is, in the short term, we will trade at a premium to NAV, and I think over time, as we transition into being a streaming company, then you trade on a PNAV multiple, which is in line with other streaming companies in the Canadian market.
Cobalt 27 has roughly $200 million following the successful IPO that you just completed. What does Cobalt 27 own for the most part for investors looking to invest in the company? What are they buying into right now?
So we've actually purchased the physical, so we own it. Cobalt 27 owns it. We own 100, and I don't know what the mark is, but for the sake of a number, you could just do the math on 2,100 metric tons, but it's around $185 million of cobalt, and we also have cash. So right now, today, when you purchase the stock, what you're really buying is participation in the cobalt upside and the cobalt story, which is underpinned by the physical asset, namely the cobalt that we own, which is stored in LME fully insured bonded warehouses in Baltimore, Antwerp, and Rotterdam.
Excellent. Well, based on the response here from the audience, I'd love to get you back on maybe in some type of a monthly or quarterly installment to discuss not just cobalt, but all the battery metals. It's becoming a bigger and bigger part of a lot of people's portfolios, and I think it's also a very new thing to most investors, so education is paramount in making good decisions. If any audience members do have questions for Anthony for when we get him on the next time, feel free to drop those in the comment section on YouTube. Once again, Anthony Milewski is the chairman and CEO of Cobalt 27, and that's listed KBLT on the venture. Anthony, thank you so much for coming on the program.
Colin, thanks a lot.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?